Hi, welcome to our continuing coverage on Bombardier. We put out our first video a few weeks ago after the massive tariffs were slapped onto the company by Wilbur Ross and the Trump administration. And today we're going to update you a bit on the earnings results that came out last week, which were actually perceived very well by the market as well as by analysts who admittedly had fairly low expectations going into it. So hitting the highlights really quickly, the revenue actually missed estimates slightly. They now see about $16.3 billion, whereas the street had already anticipated for the full year putting $16.7 billion. But on the positive side of that, they now see that the full year free cash flow usage is going to be about $1 billion, which is at the lower end of their previous guidance range. In connection with this, they also announced a deal with a large European airline, and this customer agreed to purchase up to 61 C-Series aircrafts. And if you recall, C-Series is the new jet that Bombardier is manufacturing and it's testing, and now it's just about to come on market. And the key question with this is, how does this jet scale? Because if you don't get to a certain number of orders, then you can never reach that break point where you're actually making planes that are efficient and you can't make them profitably. So Bombardier has lowered the price on a lot of these earlier jets. This is why they got in trouble with the Trump administration. And this is the big source of uncertainty going forward. Well, they announced a deal with this European customer for 61 C-Series. Unfortunately, these are not firm orders, though. This is a letter of intent, an LOI, and 31 of them would be firm if this deal was signed, and there would be an additional option for 30 more. So this is still a highly contingent deal. It may already have been signed. We don't know yet, but there was an LOI at the end of the quarter. Bombardier, the management team, knew that the market needed something positive, something of note, and this certainly helped with that. Nevertheless, there's still a number of questions concerning the company. The company is going through their planning process for next year. They need about $1.5 billion to operate the company, because this is the type of cash that you need when you are building large-scale items like planes and jets and locomotives. Now, the balance sheet continues to be an absolute dumpster fire. Management believes that they will reach cash flow break even in 2018, but we don't really know exactly when that will be. On the negative side, they've had some issues sourcing engines from United Technologies. United Technologies, of course, Pratt & Whitney is the subsidiary. Pratt & Whitney has this new engine called the geared turbofan, which should be far more efficient, but this is still ramping up for United Technologies. So Bombardier, with a plane that's ramping up, is using an engine that's ramping up, and their supplier has problems. So they're seeing lower supply of the engines and therefore lower production possibilities and lower deliveries and lower revenue for 2018. Now, they think that they'll probably deliver between 40 and 45 of the C-Series jets in 2018. Prior to this, they had thought maybe 45 to 55 jets. So all of a sudden, we have a little more questions about whether or not they can actually get to cash flow break even next year, which again would throw their balance sheet in a little bit of jeopardy, because they need $1.5 billion to operate. They should end this year above $2 billion. They should end it about between $2 billion and pushing $2.5 billion, based on commentary from the conference call. So all this to say, they had free cash flow burn. They will have free cash flow burn of about $1 billion in 2017. If they run at that rate in 2018, you're flirting with that $1.5 billion range. When pressed on this in the call, they said that they are keeping their options open and they are being disciplined. They need to complete the planning cycle. They want to be careful on CapEx. On the positive side, the business jet business is now sold out. The Global 7000 is sold out. This competes at the high end. So think about your high end Gulfstreams, the new G650 that's coming out. And this Global 7000, the high-end jet, the one that costs $70 to $80 million, that is sold out through 2021. This provides cover, I think, for the 2020 financial model, which Bombardier has come out with. On the locomotive side, this is a business that's operating very, very well. Their EBIT margin is already higher than I thought it would be in 2020. The revenue is strong. It was up 20% year over year. Orders were up 8%. And I think they have clear visibility to getting that revenue to $10 billion in 2020. In fact, they said as much on the call. The final segment they have is the aerostructures segment. And this basically supplies all the other businesses. 75% of the sales are internal. So as the business jet business goes, as the commercial jet business goes, so does the aerostructures business. So still a lot of uncertainty at Bombardier. It's still a company with a very, very, very high level of debt, and there's this distinct non-zero chance of bankruptcy. Having said all that, it's messy and it's a swamp, and sometimes you can make a lot of money in the swamp, but you have to be able to gut it out. And that's what Bombardier is trying to do. Management has already said no to bankruptcy once in 2015. They want this company to operate as a going concern. Canadian people do, the Canadian government, which is an investor in Bombardier, wants it to. It all still remains to be played out, but this quarter was a step in the right direction. They're getting some orders from the jets, and hopefully in 2018 we'll see some more progress to that break-even point in cash flow, which will give the market a lot more confidence in terms of the future trajectory and sustainability of Bombardier as a going concern. Thanks.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.